Day trading is on easy mode for beginners in 2026, and almost no one understands why. And no, I'm not saying trading itself is easy. I'm saying the starting point for beginners has completely changed. If you're stuck right now, winning some days and losing others, this is usually where things break down. It's not discipline, it's not psychology, and it's definitely not because you're just bad at trading. It's because most people are still trying to trade the same way beginners were forced to trade years ago, even though the game has changed. And until you understand what changed, everything will feel harder than it needs to be. I trade what I call the Trinity Model, a simple, repeatable framework that's built for how trading works now and not how it used to work. And this isn't just me. One of my students, Justine, recently made $3,000 in just one day trading this exact model. But the interesting part isn't the money. It's why that result is possible for beginners today and why it wasn't previously. In this video, I'm going to break down what shifted, why beginners actually have an edge in 2026, and how to approach day trading with structure instead of guessing. By the end of this video, you'll understand why trading feels so different now and how to use that to your advantage. For a long time, day trading wasn't hard because strategies didn't work. It was hard because beginners were playing the game with a massive disadvantage that no one talks about. And until recently, there was no solution. Most beginners think the reason they struggle is execution, indicators, or emotions. But there was a much bigger problem hiding under all of that, and it had nothing to do with how good your strategy was. The biggest problem beginners always had was capital. If you wanted to make a meaningful amount of money with day trading, you had to have a lot of your own money. Trade small and the results felt pointless. Trade bigger and one mistake could wipe out months worth of progress. That pressure forced beginners into bad decisions, over trading, over leveraging, and breaking rules. Most people didn't fail because they couldn't trade. They failed because they were undercapitalized and trying to force results. And this is why so many traders stay stuck for years. Even with a decent strategy, the math was still stacked against them. Because the way they were forced to trade made consistency almost impossible. When you're trading only your own money, every single loss feels personal. Every drawdown feels like failure, and that pressure makes it almost impossible to trade objectively. Instead of focusing on process, beginners focused on outcome. That's why people jumped between strategies, chased setups, and revenge traded. Not because they were undisciplined, but because the environment they were trading in was broken. But here's the part most people don't fully understand. So the problem was never that traders were lazy or undisciplined. It was that they were trying to learn in an environment that punished every mistake. When every loss feels personal, it's almost impossible to trade with clarity. But there is a way to remove that pressure. And it starts with who takes the financial risk while you're learning. And that's exactly what prop firms do. Instead of risking your own money, you're trading the prop firm's capital. Your job isn't to gamble or get home runs. It's to follow rules, manage risk, and prove that you can trade consistently. If you can do these three things, then you will be able to take out 80 to 90% of the profit you made, all while risking their capital and not yours. Prop firms don't make trading easier, they make learning easier, because they separate skill development from personal financial stress. And when that pressure is finally removed, consistency becomes possible. Quick pause before we move on. If you're watching this and thinking, this makes sense, but I don't want to figure this out alone, that's exactly why I offer a one-on-one lifetime mentorship. It's how I personally help traders apply this stuff the same way I trade it, instead of jumping between strategies or guessing. If you want details on that, the link is in the description below. Alright, now let's get into the model itself, because capital only works if you know what to do with it. Now that you have access to capital, the worst thing you can do is start trading randomly. Because the Trinity Model doesn't start with entries, it starts with context. And that context always comes from the higher time frames, specifically in the form of a high time frame fair value gap. High time frame gaps show where the market moved with real intent. They tell you where institutions were aggressive, where price became inefficient, and where the market is likely to care again. Without this step, every low time frame gap is just noise. You might win some trades, but you'll never know why. Really quick, if you don't know how to identify fair value gaps, it's super simple. All you need is 3 candles, 1, 2, and 3, in which the first candle's wick does not overlap the third candle's wick, and you have a space of a body between those two levels. This becomes a fair value gap, and you expect price to return to this level in order for it to go higher, assuming it's a bullish fair value gap, like this one. Here we have a bearish fair value gap, where we have 1, 2, 3 candles, in which the first and third candle wicks do not overlap. In this scenario, we would expect price to return to this in order for us to go lower. Looking at this example, I'm on my 4-hour chart here. And I'm going to extend this 4-hour bullish fair value gap out and wait for a tag into it. That will be step 1 of the Trinity Model. Down on my 1-minute chart here, you can see market opened right here and then dug down into this 4-hour bullish fair value gap. Now that we're inside of this gap, we can look for step 2. So now we know where price matters. You've identified a high time frame gap and you're waiting patiently, but this is where most traders still get trapped. Just because price enters a high time frame gap does not mean it's ready to reverse. Sometimes price will just keep pushing straight through this gap. Sometimes it reacts, and sometimes it does absolutely nothing. So before I can even think about an entry, I need another piece of information. I need to know whether the market is actually losing strength. That's where SMT comes in. Here I've drawn out two of the same market structure. This market is going to be NQ, or NASDAQ. This market is going to be ES, or the S&P 500. These two assets are what are called correlated, which means that whenever NQ moves up, ES also moves up, and whenever NQ moves down, ES also moves down. But what happens when we get a crack in that correlation? NQ making a lower high and a higher high, while ES puts in a higher high and a lower high. This is what's called SMT divergence, and it means that smart money is actively participating in these levels before a massive dump. And I'm looking for this to occur when we tag into that high time frame gap, making this step 2. So if we come back to this example here, you'll notice when we tagged into this high time frame gap, we swept this low right here, forming a higher low and a lower low on NASDAQ. Well, if I look at ES in the exact same spot and zoom in, you'll notice that here we have a lower low and a higher low. That same low that NASDAQ swept, ES did not sweep, meaning that we have SMT inside of that high time frame gap. So now we have alignment. We know where price matters, and we know that the market is losing strength in this area. But even with all of that, I still haven't entered a trade, because confirmation is not the same thing as execution. This is where most traders rush. They see confluence and they jump in early. I still have to wait for one final signal to enter my trade. That signal comes from how price behaves after we form SMT. This is where inversion gaps come in. Earlier I talked about bearish fair value gaps, but what happens when we get a candle that closes straight through one of these gaps without respecting it? Anytime you see a bearish fair value gap get closed above, or a bullish fair value gap get closed below, it turns into what's called an inversion gap. At this point, we've disrespected this gap, which means that we're no longer expecting it to push price lower. Instead, we're going to anticipate this to push price higher. That's why we use this as an entry signal, because it's telling us that sell side is no longer interested and now we're on the buy side of the curve. So if I'm looking for buys, this would be my entry. Looking at our 1-minute chart here back at this example, you'll notice we have a bearish fair value gap that formed right here. That bearish fair value gap got closed above, turning it into an inversion. So now I can finally take my entry and place my stop below this low. And we'll target a 2R, and I'll target the high of this 4-hour candle. Let's play this out. As you can see, we did hit that target quite nicely. This is the part where traders start to get stuck again. They understand the model, they understand prop firms, but now they're stuck staring at dozens of different options, rules, and account types, and choosing the wrong one will set you up for failure immediately. If I had to pick one prop firm to trade with, it would be My Funded Futures. The reason I suggest starting with My Funded Futures is because their floor is very, very low. The entry price to get into one of these accounts is $107. That's nothing compared to the $2,000, $3,000, $4,000 you would have to risk of your own capital to start trading these futures in the first place. The way these valuation accounts work are very simple. You have all your rules laid out for you right here. In the evaluation account, once you pay the $107, they will give you an account that has $2,000 worth of drawdown, and you have to make $3,000 to pass the account. So say you risk $200 per trade. That's 10% of your drawdown per trade. It would take you 10 trades in a row to lose this account, which, by the way, with this Trinity model is very difficult to do. Let's assume you're trading $200 per trade at a fixed 2R. It would take you about 7 or 8 trades to pass this account and get moved into a funded account. Once you have the funded account, you just do the exact same thing. 10% of your drawdown per trade, and the only rule here to actually make money is you need 5 winning days of $150 or more. Which means that at risking $200 per trade, you need 5 wins. 400 times 5 is $2,000, so that's roughly a $2,000 profit, assuming you don't lose any trades, which you probably will, but that's mixed in with the win rate. So assuming you trade the exact same that you traded on the evaluation stage in the funded stage, you should reach that payout level pretty soon. So let's say you have $2,000 in profit, you can request $1,000 and keep trading with the $1,000 that's in your account. And you can do that every 5 days. So every 5 days you can take out $1,000, assuming you're winning those trades. But that is exactly how I and many of my students go on to make $10,000 months pretty consistently using this exact model. All you have to do is borrow prop firms' money, pass their accounts, and trade with them. If you guys want to start with a MyFunded Futures account, I recommend using code Colin for the best available discounts. I don't know if there's a sale going on right now, but if you use that code on one of these accounts, you will have a discount at some point. Just keep in touch with MyFunded Futures sales. It'll mimic the best sale each time. Thank you all so much for watching this video. I hope you got a lot out of it. I recently made a full beginner course on how to start day trading in 2026. And if you want to watch that video, I will leave it right here, so you can go ahead and click on that pop-up to watch it. Otherwise, please leave a like and subscribe. It greatly helps me out. And comment down below what you want to see from me next. Thank you all for watching, and I'll see you in the next video. Peace.